Hello, and welcome to a webinar entitled Packaging and Economic Development Deal, Intro to Gap Financing and Tax Credits. This webinar is put on in conjunction with the Georgia Rural Zone Program and the Georgia Main Street Program. My name is Cam Yurdy, but you don't really need to pay attention to that because by the time you get around to watching this webinar, I will no longer be with DCA. However, I'm leaving you in fine hands with a number of capable folks whose contact information I will give you at the end of the presentation, and you can take their information and reach out to them if you have questions about either the presentation, the Georgia Main Street Program, or the Georgia Rural Zone Program. So let's dig in. Today's session's goals are, we have four main goals. We're going to start by understanding some common terminology associated with economic development deals. We're going to set up a potential deal, walk through the different components that go into making this deal happen. We're going to discuss gap financing as a tool to take a traditionally financed project and make it potentially more appealing to both banks and the potential developer who's coming in. And then we're going to discuss Georgia's Rural Zone tax credits, what that program may do to a project to make it, again, more appealing to various investors. And so before we begin, I want to take a moment and point you to some of the supplemental training documents that we have associated with this webinar. You can see that we have three different files uploaded for supporting documentation. The first of which is a basic project calculator worksheet. Now this worksheet really is an estimation tool to help you log it down some of the numbers associated with the various economic development deals and see how the changing different components of that deal may impact the bottom line on the project. You'll note that this is for estimation purposes only. I would not take this document itself to a bank, but it is helpful to do some sort of back of the napkin calculations that may help you at least get your mind around whether or not a deal even has a chance of moving forward. So you can find that document, and we'll go through and reference it at different points. You don't have to follow along by using this spreadsheet, but I will at different points in the presentation point to places where you can go and enter information into this worksheet. So if you want to follow along with that, go ahead and take a second, pause the presentation, and start opening that document so that you can follow along if you so desire. The second and third document that are attached, just two different versions of this loan constant table. At one point in the presentation, we're going to talk through how you can do a quick calculation of annual debt service. And if you don't know that term, that's fine. We'll cover that a little bit later. But the loan constant table will be helpful to you in that regard. And there's an Excel version of this file as well as a PDF version. And again, we'll cover that in a little more detail when we get further into the presentation. So what are we not covering today? Well, we're not chasing unicorns. Today is not about finding that once-in-a-lifetime economic development deal, that mega site project that will make 2,000 jobs and millions of dollars of investment come to your community. No, today we're going to talk about how to package deals that probably already exist in your community. So in talking about that, let's get a little background on what the Main Street program in Georgia does. So in 2018, our Main Streets, our Georgia Main Street programs combined reported 1,159 new or expanding businesses, which generated over 3,000 jobs and almost over $500 million in public and private investment. These are huge numbers. If you take what our Main Streets do in small towns all across the state every year, you almost equal one Kia plant, so one mega project each year just in our downtowns across the state. We have 115 communities that are affiliated in some way with the Main Street program, which represents only a fifth of the cities in the state. So that should tell you that there's a lot of potential for smaller scale projects that can create real solid economic development. And luckily, our state has provided a number of tools that we'll talk about later that can help these businesses and these projects get off the ground. The U.S. Small Business Administration puts out some numbers every year detailing the state of small business across the country, and they estimate that almost 60 million people are employed across the country in small business enterprise, which is almost half of the private workforce and this is not Walmart, Amazon, what you have it, but the small mom and pop type organizations that employ 1 or 2 to 10 people or so. And so this comprises a really large portion of our economy, and thus there are more opportunities for working with these small businesses as opposed to your larger organizations. So as you see here on the slide, firms with under 100 employees have the largest share of small business employment, and firms with less than 20 employees experienced the largest gains in 2017, I believe is the latest year we have numbers for. They added over 1 million net new jobs across the country. So there's a lot of potential here, and just anecdotally from our experience with the Georgia Main Street program, these type businesses are the ones that we see filling our downtowns day in, day out across the state. And so as we transition into looking at the project and the terminology we're going to discuss, I want to give you put a vision in your mind of one of my friends called Dr. Leslie. And Dr. Leslie is obviously fictitious, but for the purposes of today, Dr. Leslie is a dear friend of mine. Dr. Leslie is a cardiologist in Albany, Georgia. She lives in the small town bedroom community of Sylvester, but working as a cardiologist in the big city of Albany, she makes about $400,000 per year. Annually, she pays $24,000 or so in state income taxes alone. We'll come back to Dr. Leslie a little later in the presentation, but for now, I want you to just think about, visualize Dr. Leslie, and also visualize the somebody like Dr. Leslie that lives in every town. So imagine the person who has that higher income and is living in your town. These are the people we want to try to convert from high-paid employees or wealthy-ish residents of our town into small-time developers that can support and sustain small businesses through project financing, such as what we'll talk about in a minute. So when our Main Street programs, when our Main Street managers begin working in a new program, it never fails that the one question that always gets asked is, so when are you going to do something with the old whatever building? Buildings that look just exactly like the one you see on your screen here are present in almost all of our downtowns. And people see these buildings and think a lot of different things when they see them consistently vacant in their downtown. So take a second and think to yourself, what do you see when you look at this? What does the community see? The community being the residents at large of a community. And finally, for the purposes of today's presentation, we want to ask ourselves, what does a developer see and what are they looking for? This is the building that we're going to be working through with this presentation as an example, and we'll talk more about what the developer might see in just a few minutes. To begin, let's talk about a few real estate development terms. These are the different terminologies that we'll be working with. You may hear some of them abbreviated, and you will hear me talk about some of these terms. And also throughout today's presentation, there are a number of small, short videos, animated videos that we've created to assist with understanding some of these concepts. And so we'll talk in more detail about these different terms as we go through, but for now, let's briefly cover what they are. So ROI is return on investment. That's the money you want to make. We have net operating income, which is abbreviated NOI, cash on cash rate of return, total project cost, TPC, that's a big one. That's a very early on number that we have to know. Debt coverage ratio, DCR. And then the big question, at least early on in this training, is CF greater than DS. So is your cash flow greater than your debt service? And that's a question we're going to be grappling with in a second. So going back to the 121 Main Street building that's in any town in the state of Georgia, we need to know a few basics about this project before we can determine what a developer may see in the building, and how we can move it forward from a vacant building that's been in our downtown for 20 years vacant to a productive building that's contributing to the vibrant economy of our town. So first off, it's a 6,000 square foot building, and it's within our downtown district, so it's right in our downtown core. From a developer standpoint, there are 2 stories that could be turned into something. For today's presentation, let's assume that in the upper level, we've got 2,700 square feet. So we can do 3 900 square foot loft apartments in this building. And on the bottom floor, we've got 2 separate commercial units equaling 1,500 square feet apiece. So we've got 2,700 square feet of residential and 3,000 square feet of commercial on the bottom floor. We know that the owner really thinks a lot of the building. The owner wants to sell the building and the land for $150,000. The projected rehab cost for this project to get it up to where that 2,700 square foot of residential is leasable and the 3,000 square feet of commercial is also leasable, that's going to cost another $150,000. And of course, something's going to go wrong, and we need 10% of contingency funding so that when we're in the process of constructing and rehabilitating this building, we can cover any unexpected costs, which will most assuredly pop up.
So let's take a minute to talk about TPC and NOI. First, we're going to talk about TPC, otherwise known as total project cost. So let's take a typical downtown property. The owner is asking for $150,000 to purchase the property, and we know that there's approximately $150,000 worth of renovations needed in order to get us move-in ready. To calculate the TPC, we take the $150,000 asking price, added to the $150,000 construction cost, along with the 10% construction cost contingency equaling $15,000. Together, this gives us a total project cost of $315,000. Now we're going to talk about net operating income, also known as NOI. After we complete renovations on our downtown building, we need to know how much income this property can produce. We have 2 potential revenue streams, including upper-level residential and lower-level commercial. One way to calculate our earning potential is by determining the income per square foot. Through market research, we have determined that the average cost per square foot is 75 cents for upper-level residential and $1 per square foot for lower-level commercial. To calculate our effective gross income, we take the 2,700 square feet of upper-level residential and multiply it by 75 cents, giving us approximately $2,000. For the commercial space, we take our 3,000 square feet and multiply it by $1, giving us a total of $3,000. Taking into account both upper-level and lower-level earning potential, we have an effective gross income of $5,000. To calculate our NOI, we take our effective gross income, we subtract out our TUMMI and our 10% vacancy rate. TUMMI stands for Taxes, Utilities, Management, Maintenance, and Insurance, and our 10% vacancy rate is calculated off our effective gross income, giving us the total NOI of $3,000. Now that we know our total project costs are $315,000 and our net operating income is $3,000, what can we deduce from this? Let's go back to our worksheets and see.
Okay, thank you, Jessica, for that wonderful video that I failed to properly introduce. As you may have seen from viewing that video, there may be a little bit of audio level discrepancy, so when future videos pop up, I'll try to give you a heads up and let you know that you may want to turn your speakers down just a tad. So, a lot of information was thrown out in that video, a lot of information that we need to work through and kind of understand how this affects our understanding of the property and the potential project. So the old saying goes that it takes money to make money, right? So we have to understand how the different funds that are associated with this project can be plugged into our sources and uses table. And if you're following along with the spreadsheet, the project calculator spreadsheet, then we're going to go through and understand where we need to plug these numbers into that document as well. So the first process that we have to go through is understanding what our total project cost is. As we mentioned in the video and before, the overall cost of acquiring the building itself is going to be $150,000. However, I want to break that down slightly because when we get to talking about the rules on tax credits a little later, it's going to matter where those funds are split up for. So you'll see that the land acquisition cost itself is going to be $15,000, and the building acquisition cost will be $135,000. And yes, so also so we'll have that building acquisition cost pop up in just a second. But the building construction and renovation, again, is going to cost $150,000. 15 or 10% of that for contingencies will give us $15,000 in contingency fees, which will be a total total project cost of $315,000. And there is that $135,000 building acquisition cost. So let's recap. We've got $15,000 in land acquisition, $135,000 in building acquisition, totaling $150,000 to simply acquire the building, to be able to own it outright. Then we have another $150,000 for building construction or renovation of the existing building, and with a 10% contingency on that renovation rehabilitation amount. So $15,000 for that, giving us a total project cost of $315,000. We have to begin with this number because everything else plays off of covering the amount that it's going to cost us in cash and loans and interest payments to make that $315,000 happen. So if you're following along with us on the total project cost or on the worksheet, let's go and open that now, and you can note a couple of places in this document. The initial screenshot that I showed of this document was on the worksheet information tab at the bottom left-hand corner of your screen. We are going to be working for now on the total project cost worksheet, and that will allow us to enter in the yellow boxes those different components we just talked about. So the $15,000 for acquiring the land, the $135,000 for acquiring the building, the $150,000 for the rehabilitation costs, and the 10% or $15,000 cost for construction or rehab contingency fees. If you scroll down to the bottom, I don't have a screenshot of this, but if you scroll down to the bottom of the worksheet, you will see where that's all summed up and showing $315,000. Notice on line 7 of the spreadsheet, there are a number of yellow boxes which should, in the version that's uploaded, be all checked no or NA. These are different calculators for some of the different tax credits that we have. We are going to be dealing solely with the rural zone investment and rural zone rehabilitation tax credit for the purposes of this presentation. However, this calculator is built in a way that incorporates the federal rehab tax credits, low-income housing tax credits, and the state historic rehabilitation tax credits, along with tax depreciation. All of this was set up after the tax bill of December 2017, so it is current as of June 2019. However, if you're viewing this at a later date and Congress decided once again to alter the rehabilitation or low-income housing tax credits or the depreciation schedules, you may need to go in and update the formulas. Or hopefully we will have published a modified version of this calculator with any changes that are made in the future. But for now, you're going to want to go ahead and click yes for both the rural zone investment state tax credit and the rural zone rehabilitation state tax credit at some point because we're going to be dealing with that later in the presentation. For now, the biggest thing is getting those numbers in column B, project costs, set up so that we can work through the rest of the spreadsheet. So a couple of things that were presented in the video that Jessica, animated Jessica showed us were talked about how we calculate our net operating income. So let's walk through that again. Jessica mentioned that we can expect to earn about 74 cents per square foot in this district for residential leasing, and $1 per square foot for commercial leases per month in this district as well. So first, let's ask ourselves, how do we know these numbers? The answer to that question is we've done our research, we've done our homework. You cannot wait until a developer comes to town to identify what your lease rates are for residential or commercial. This is work that we prioritize our Main Street managers doing in their communities when they're doing their work throughout the year. And even if you're not a Main Street community, this is research that I would highly encourage you to go out and start looking for, even if you don't have a project or a developer in the pipeline. Common sources of this information are simply asking people what they're paying for leasing in your downtown, working with realtors in your community or bankers in your community who may be able to give you more information about what they see people paying. You don't have to have it down to the penny, but it does help to understand a pretty close range so that when you're working through a potential project, you can see what a project may be able to support. We also have presented in the video earlier that we expect a 10% vacancy rate for both commercial and residential. Again, these are stock numbers. These numbers are probably not going to be what it is in your community, so you need to go out and do that research and understand. One other thing, at various points when we're talking through the spreadsheet, you will notice that the commercial lease rates are annualized. So that $1 per square foot will become $12 per square foot. And while residential lease rates are still presented on a monthly schedule when we enter it into our document. That's just due to the nature of the different leases that occur for commercial and residential properties. So again, commercials rent will typically be shown in an annual cost per square foot, while residential cost will typically be shown in a monthly cost per square foot. So let's use that information and attempt to calculate our net operating income. Remember that we had 3 900 square foot apartments totaling 2,700 square foot of leasable space. We are charging 74 cents a square foot per month. That's going to give us a gross residential rent of about $2,000 per month. Do note as well that the gentleman who initially developed this presentation and the calculations included in the videos and the presentation itself was a big fan of rounding. So some of the numbers that you're calculating on the spreadsheet, or if you're following along with a handheld calculator or whatnot, some of the numbers may be slightly rounded. So please forgive that discrepancy, but know that we are in the same ballpark when we're looking at these numbers. So again, our 3 residential units should gross us about $2,000 a month in lease income. Again, we have a vacancy rate of 10%, which is going to take off $200 from our residential monthly income. Those 2 commercial units that we have will give us $3,000 because there's 3,000 square feet, $1 per square foot per month. So we'll be earning $3,000 per month in the gross commercial rent. And that 10% vacancy rate is going to take off $300. That gives us a total gross income of $5,000, with $500 being shown as loss due to a vacancy rate that we expect to see. Gives us an effective gross income of $4,500. Now, for the purposes of this application, we expect about $1,500 a month in operating expenses, or as we abbreviated in the video, TUMMI, taxes, utilities, maintenance, another M, and another I. These expenses, when we work through the spreadsheet in just a second, I'll show you some examples of different operating expenses you may expect to see in your pro forma. But for this example, we're going to assume $1,500 per month in operating expenses, which is very reasonable. That will give us a net operating income of $3,000 per month. And annualizing that, so multiplying that times 12, gives us a net operating income over the course of a year at 12 months of $36,000. Now, one of the things that I need to talk about at this point, before we jump further into the presentation, is that we know our developer for this particular project really doesn't want to invest any more than $31,500. So make a mental note of that. Our investor does not want to put any more cash in the project on the front end than $31,500. So if we go back to our spreadsheet, we can look at our TUMMI, our operating expenses, under the annual operating expenses sheet of the calculator. And we're going to be primarily looking at year one costs. But because this is a 10-year calculator, I've gone ahead and filled it in. And you can see the numbers that I used. $1,500 per month equals $18,000 per year in operating expenses. And because the spreadsheet is done on an annual basis, I've gone ahead and said that electricity is going to cost us about $2,000 a year. So will sewer and water expenses. Trash will run us $1,000. Property taxes are going to cost $5,000. Insurance, that was the other I, will also run us about $5,000 a year. And payroll and taxes to manage the building will also cost us about $1,000 a year. So you can use any numbers you want to, so long as for the purposes of this example, they equal $18,000. And again, we've thrown in other common operating expenses that you'll see, such as marketing, legal and accounting, any property management, repairs, decorating, maintenance. If you have natural gas, that's going to be a fee that comes around regularly. If you happen to have a pretty lawn or a planter box out front, you may have some grounds maintenance. And we are in the South, so we do have bugs, so you may want to look at exterminating expenses. And then there's a category for other, for those other fees that you may encounter. And then, because we've got our information on what the project could potentially earn us, let's go ahead and take a second and enter in our annual project income. For that, you'll want to click the Annual Project Income tab at the bottom. And we'll enter, again, for our residential, we're going to enter the number of square foot there in year one, which is 2,700. That's in column B. Then we'll also enter our monthly square foot rent rate for our residential, which is 74 cents. And that gives us almost $24,000 in annual gross rent. For the commercial square footage, we have 3,000 square feet of commercial we'll be leasing, and an annual rent rate of $12 per square foot. And that will give us exactly $36,000 in annual gross commercial rent. We're not going to consider tenant contributions or any other income, like maybe we have a parking lot associated with this building and we can charge for parking. We're not going to put anything in that for the purposes of today's presentation, but that is something you may want to consider if you're working through a project and you have some of those assets. The other things that we do want to enter in here are our vacancy rates. And so that's 10%, and that is irrelevant if it's monthly or annual. But we will enter that 10% twice for both the residential and the commercial. And this is going to allow the spreadsheet to calculate on the next page, which is the pre-tax cash flow. That will allow us to calculate our net operating income. And you can see the bottom line there in column C. Our net operating income is $35,978. For the purposes of the rest of the presentation, we're going to call it $36,000 in net operating income. There are portions of this spreadsheet below the NOI calculation, and we'll get to those in a bit. But for what we've had introduced so far with the standard terminologies that we've learned, this is as far as I want to show. And again, notice that that runs out for 10 years. Obviously, your rent rate's probably going to change over the course of that 10 years, so you'll want to understand what that looks like. But again, for today's presentation, we're only going to be really looking at year one. Okay, so let's talk for a second about how we may get the $315,000 of total project cost invested into the project. So typically, a standard loan from a bank is about 80% of your total project cost. That's sort of the rule of thumb that you use when buying a house or when opening a business or rehabilitating a commercial building or building a commercial building. That's what a lot of banks are comfortable with, and that's the numbers that most people hear thrown around. 20% comes from you, 80% comes from a bank. And so let's take a second and work through that sort of standard historical framework of 80% bank financing and see what that looks like for the purposes of this project. 80% of $315,000, which is our total project cost, that comes out to $252,000 of bank financing if we use that traditional structure. So we've got our total amount there. Let's assume that the bank wants to finance this project for 10 years at 8% interest. Now, the interest rates have been quite low for some time, so this may not be an accurate reflection depending on when you're listening to this of what the interest rate is. But again, for the purposes of today's presentation, we're going to look at 8% interest over the course of 10 years. To understand what it's going to cost us as someone who's taking out a loan or a developer who's taking out a loan and then having to repay it, there's another component of terminology that we need to introduce at this point, and that's the constant. If you'll recall, one of the supplemental documents that you've got attached to this presentation is that loan constant table. You've got it in both PDF and Excel format. So you can take a look at that, and we can look up our the two different components of our bank terms here, which is 10 years of financing, so 10-year term, and 8% interest. If you pull that loan constant spreadsheet up, you can go and see where those two cross and see what the loan constant is for this loan. When you go and pull that number, you will see that the loan constant is 0.1456. So what does this loan constant allow us to do? If we multiply the amount of the loan, which is $252,000, by that loan constant amount, it's a shorthand way to come up with what our annual debt service is. Again, we've done a lot of rounding here for the purposes of this presentation, but when you multiply 252,000 times 0.1456, you get a number that's close to $37,000. And so what is annual debt service? That's the amount of money that we're going to have to pay the bank annually to pay back this loan at the terms that were provided and the amount that was loaned to us initially. There will be a short video in just a second that will show what that looks like and give a better illustration of that concept. And so, remembering that our total project cost is going to be $315,000, if the bank loans us $252,000, that leaves a $63,000 equity injection that we have to make, or the developer has to make this project happen. If you'll recall from earlier in the presentation, we talked about what the potential developer for this scenario is looking to invest, and it was not $63,000, it was $31,500. So let's continue along the presentation and see what we can do about that. Again, to calculate debt service is just putting into words what we went through a second ago. You multiply that loan constant times the amount of the initial loan. So our constant, again, for a 10-year loan at 8%, the constant is 0.1456. Again, this is a shorthand way to calculate debt service. In that spreadsheet, and I believe on the PDF version of that constant table, There is the actual formula that you can use to calculate that constant, or you can go to any number of calculators that are found online, plug in the loan term and the interest rate and the loan amount, and that will help you calculate debt service as well if you don't have your loan constant sheet handy. So some questions. The first question that we need to ask ourselves is the potential owner or developer willing to invest $63,000? The answer to that question is maybe. We need to know the answer to number 2 and understand why we know the answer to number 2 in order to answer number 1. So question 2 is this a wise investment or a good deal, and how do we know? Well, for that, we need to turn it back over to Jessica for a video. Again, you may want to adjust your sound level if that first one was a little loud, and evaluate the cash-on-cash rate of return.
So you might be asking yourself, what is cash-on-cash rate of return, and how do we calculate it? So basically, the cash-on-cash rate of return is the relationship of the cash invested into a property to the cash flow gained from a property, which is also known as the annual net cash flow. In order to calculate our cash-on-cash rate of return, we would take our annual net cash flow and divide it by our original cash investment. In our scenario, the annual net cash flow is equal to $36,000. When we divide this number by our original cash investment of $63,000, we get a cash-on-cash rate of return of 57%. At this point, you might be thinking, wow, a 57% rate of return, let's do it. Whoa, hold on there, cowboy. Don't forget about that loan repayment, or what we call debt service. So to recap, when calculating our cash-on-cash rate of return, we need to make sure that we account for our annual debt service. To do this, we will take our net operating income, or NOI, and subtract our existing debt service. This will leave us at a loss of $1,000. When we take our newly determined cash flow and divide this number by our original investment of $63,000, we get a more accurate cash-on-cash rate of return of -2%. And that's how you calculate the cash-on-cash rate of return.
Okay, so we're going to lose $1,000 each year we have this project. That's amazing, isn't it? So if you're following along with the project calculator worksheet, we can enter some of this information to allow us to determine what our cash-on-cash rate of return is. But first we need to put in the information for our loan amount. So if you go to the loan principal payments tab, it's the very last tab, titled loan principal payments, you can input the loan amount for loan 1, and for this project so far we only have one loan. So that loan amount again is $252,000. Our interest rate is 8%, and because we're rounding today, we're going to say that our debt service is $37,000. If you look at the end, this is only a 10-year calculator, so we don't calculate if you had a loan longer than 10 years. We don't show what that looks like on this document, but for a 10-year loan with a 10-year calculator, the last number on year 10 new principal should be 0, but because we've rounded, we've overpaid the bank a little bit with this debt service. It's really something like $36,800 or something, if memory's serving correctly, but $37,000 for the purposes of today's presentation, and this will show you what those loan payments are going to be going towards. In the first year, you're going to pay almost $20,000 in interest, only $17,000 in principal, going down to the last year where you pay $1,100 in interest and $35,000 in principal payments. So once we've entered in that information about our loan to calculate that loan and the debt service payments, we can go back to the pre-tax cash flow sheet that we were on earlier, and you can see we've scrolled down here from the net operating income that was already entered, and we can see our cash-on-cash rate of return. So this is sort of the first sniff test about whether the project makes sense or not. And if we look at year one, which is the year we're concerning ourselves with, the lines, column C, lines 23 through 25 are merged to show one specific calculation for cash-on-cash rate of return. And you can see there we're losing 1.6% a year, which is almost $1,000 a year. That's not good. That's not what we want to do. We really want to make money when we do a project. So let's continue on and see how we can do that. Again, when we have to pay our $37,000 in debt service, we're already out $63,000 in initial equity to create the loan, create the project, make it happen. We're definitely losing money. Another concept we want to introduce at this point, though, is what's called the debt service coverage ratio, or debt coverage ratio. This is the amount of money, and we'll get into it with a video in just a second, but this is the amount of money that your bank is going to want you to generate in net operating income from the project in order to cover the amount of debt that you're going to be taking on to make the project happen. A standard sort of back of the napkin number that a lot of banks like to see is 1.25. That can range anywhere from 1.2 to 1.4, depending on the bank or the institution that's giving you the money. But for the purposes of today, we're going to assume that our bank wants to see a debt coverage ratio of 1.25. So without further ado, here's Jessica again to walk us through what debt coverage ratio is and how we look at it.
So now we're going to talk about financing and debt coverage ratio, also known as DCR. When we talk to the bank about our project, a traditional deal structure will look similar to this. We have already determined that our total project cost is equal to $315,000. Knowing that the bank will only finance 80% of the total project cost, we can calculate the potential loan to be $252,000, leaving the prospective owner responsible for covering the remaining $63,000 gap. Taking the bank's $252,000 with terms of paying back the loan over 10 years at 8% interest, we can calculate our annual debt service to be approximately $37,000. But the bank wants us to have a debt coverage ratio of 1.25. So what is debt coverage ratio, and how do we calculate it? Think of it like this. The bank lends you money for a specific project, but for every dollar that the bank lends you, they want to make sure that this project produces $1.25 to cover the repayment of the existing debt service, giving you the desired debt coverage ratio of 1.25. We had previously calculated our net operating income at $36,000. Dividing this by our debt service of $37,000, this gives us a debt coverage ratio of 0.97. However, we need to keep in mind that any number below 1 means that our project will not produce enough money to cover our debt service. Let's take this existing formula and figure out a debt service that we can afford. Taking our net operating income of $36,000 and dividing it by the bank's desired debt coverage ratio of 1.25, we now know that we can afford a debt service of $28,800. Let's take another look at our numbers. We know that the net operating income is $36,000. We also know that the bank wants a debt coverage ratio of 1.25, meaning we can afford a debt service of $28,800. The terms of the loan have not changed, so our constant remains the same. Referring back to our formula sheet, we know that the way to calculate debt service is by multiplying the loan amount times the constant. Conversely, if we want to calculate our new loan amount based on our adjusted debt service, we can take our $28,800 and divide it by our constant of 0.1456. This gives us a newly calculated loan amount of $198,000. Let's go back to the worksheet and take another look at the problem.
All right, so how many of you out there listening right now were surprised to see algebra coming into play here? Yeah, we threw that in on you. Hopefully everybody's thinking back to 8th grade and how we flip equations. But we'll walk through that in just a second again, just to make sure we've all got it. And if you need to take a second to rewind the presentation and listen to that again, by all means, won't hurt my feelings. I'll never know. As we had the initial 80% financing, the traditional 80% financing, 20% owner equity, we were looking at a $252,000 loan with the terms that were given, $63,000 of owner equity with an annual debt service of $37,000 that was exceeding our net operating income by $1,000 a year, meaning we were losing $1,000 a year. The bank wants to see a desired debt coverage ratio of 1.25. So how did we get there? Well, our standard formula is that our debt service coverage ratio, or DCR, equals our net operating income over our debt service. Swapping that, if you again recall back to algebra, you'll remember that you can take the bottom number on the right there, that debt service, move it over to the left, and move that left number back over to the bottom right. And that will allow us to have a formula that can help us calculate what our potential debt service is that we can carry with the income that this project is producing. Before we move on, I do want to stress that one of the things you don't want to get involved with if you are working through a potential project is fudging the numbers on that net operating income to see, oh, maybe I can squeeze an extra 2 cents a month out of the residential lease, or maybe I can get $1.20 per month or $13 per year in commercial lease rates. If you do your research right on the front end, those numbers are pretty fixed as you're going through the process of calculating the project and its potential, whether or not it has potential to happen or not. And so you don't want to get into the business of fudging those net operating income numbers to see if you can maybe assume more debt than you initially thought, because what you're really going to do there is set yourself up for failure in the long term. So we have our new formula here. Our debt service is going to equal our net operating income divided by our desired debt service coverage ratio. So we have $36,000 we anticipate earning in a year as our net operating income. Our bank wants to see a 1.25 debt coverage ratio, which allows us, if we take $36,000 and divide it by 1.25, to have an annual debt service of $28,800. And if we recall, we used our constant to determine what our debt service would be when we knew the loan amount. Well, now we still know the constant. That constant hasn't changed because the terms of the loan haven't changed. The bank is still wanting to do a 10-year loan on 8% terms. So that constant is still 1.1456, and our debt service we now know is $28,800. So we can multiply those two together, divide the debt service by the loan constant amount to give us our total loan amount of $198,000, which is telling us essentially that with the amount of money we see with the potential to make from this project, we can cover a loan, an initial loan of $198,000. Everybody good? If you're not, again, take a chance, rewind, hit the points that you need to cover again. So what does this mean to our deal, and what does this mean to the financing of the project? 10-year term, 8% rate, $198,000 loan amount, giving us an annual debt service of $28,800. Our total project cost hasn't changed still, which means our owner, our developer, is going to have to input $117,000 of cash equity on the front end just to make the project happen. If we remember from earlier in the presentation, we said that the developer or the person that's interested in this building only wants to put in at a maximum $31,500. So that puts us in a little bit of a pickle, doesn't it? Again, we're just going through here and calculating what our cash on cash rate of return is. So we take our $36,000 of net operating income, subtract out our debt service. That gives us $7,200 in cash that's going into the developer's pocket. We'll want to divide that by the amount of equity that the owner or the developer is putting into the project at $117,000. And that's going to give us a 6% cash on cash rate of return, which granted isn't bad. 6% to some folks sounds like a perfectly reasonable amount return, but this is a pretty high initial investment for the developer over what they initially wanted to put in. So we do need to take that into consideration. Is that 6% return enough to encourage them to invest 3 times the amount that they initially wanted to invest? If you're following along with the spreadsheet, we can go in and update the terms of our loan in the loan principal payments. Again, we'll make the loan amount $198,000, keep that interest rate there at 8%, and input our new debt service amount at $28,800. And we still round it a little bit, but if you look in year 10, in the new principal line for loan 1, you'll see that that amount remaining is $418, which is a heck of a lot closer to zero than it was earlier. So we're getting closer on our rounding. And again, we can go back to the pre-tax cash flow sheet and scroll down to the bottom there where we'll see our year 1 cash on cash rate of return at 6.1%. So the question now that we know what the return is going to be of 6%, we know what the equity investment on behalf of the owner or the developer needs to be, which is 3 times the amount they want to invest. We have to ask ourselves a very important question. Is the deal dead? Is the deal dead? Do you think it's dead? Take a second and discuss amongst yourselves. Okay, I'm biased because I'm leading this training, but I would say that the deal is not in fact dead. It's simply time to negotiate. At this point, we've covered the basics of what goes into a project, determining the different number of components with our net operating income, our debt service ratio, our debt service, all of those different components that we've talked about for the past 45 minutes or so. Now we understand what the bones of the deal can look like. We now need to look into our toolbox and determine what we have at our disposal that may allow this project to happen with both the bank being comfortable with the amount they're loaning and the developer being comfortable with the amount of money they're putting in. And so the first tool we're going to look at is what's called a 504 loan. And this is where we're going to talk about gap financing. And there's an old saying in economic development. I know it's in planning, but it's in economic development too. And the saying goes, it's not how much the project costs, but it's how you pay for it. So what we're going to do with this gap financing tool is we're going to look at not changing the underlying dynamics of the project. The project's still going to cost $315,000 no matter how we slice it. What we're going to look at is how we pay for it, how we finance that initial investment, and how that the numbers from our net operating income that are, again, still the same, are going to go back into paying off the different debt tools that we use to create the project. So a 504 loan is a shorthand way of saying the 5 stands for 50% traditional financing. So this is where your bank comes in and loans 50% of the project cost. The 0, total misnomer, stands for 10% owner equity. So your owner is only putting in 10% of the total project cost instead of the traditional 20% that we talked about initially. And then 4%, the 4 is 40% for gap financing. So this is a different loan that we're going to take out to help us equal 100% of the total project cost. And so one of the concepts that we need to think through for a second before we go into what this looks like on the pro forma is we need to understand that with the bank coming in at only 50% of the financing and having an additional partner in the gap financing lender on the project, the bank is willing to change the terms because they are assuming less risk. However, upping their or keeping that only being involved at 50% of the project does mean that they may want a higher debt coverage ratio to ensure that they get repaid along with the other lender that's now on the project. So we'll walk through this example a little bit and go from there, and hopefully we can understand what we're looking at here. So again, the same sort of formula we're looking at. We're going to be looking at 2 different loans and some owner equity in the project. The modified bank financing here is going to be at 50% of the total project cost. So That $315,000, 50% of that is $157,500. That's going to come from our traditional bank. And again, this is a great point to plug your relationship with community banks that are already working in your town. They're going to, if they've never worked on a project that has some sort of gap financing or tax credits to make the project work, they're going to require a good relationship with you, the economic developer, with the owner or the developer who's coming in and doing the project themselves, and the other partner who may be bringing in the gap financing funds. So you will want to make sure you begin this sort of process by cultivating that relationship with the local banks. If you have more than one bank, you may want to bring them all together and discuss what this tool looks like and how you can use these tools to make projects happen. But really, it's the relationship component that I wanted to take a second and stress before we move on to what the rest of the financing looks like. Okay, so off my soapbox for a moment. We again have that initial bank or the traditional bank financing of $157,500 on the table. Total project cost still going to be $315,000. Our bank terms do change though, because they are taking less or putting less money into the pot. They are willing to extend that loan repayment to 15 years instead of 10. So our term changes to 15. Our rate changes to 8%, and that's going to do what to us? That's going to give us a new constant, because the basic underlying terms of that loan changed. We need to go back to our constant table, loan constant table. Take a second to do that now if you'd like. And we need to look up what the new constant is for a 15-year loan at 8% interest. If you got it, you know that that's 0.1147. So now we have all the components that we need to understand what our annual debt service for this first loan is going to be. So again, we're going to take that total loan amount, which is $157,500. We're going to multiply it by our constant of 0.1147, and that's going to give us our annual debt service for this loan alone being at $18,000. Okay, so we got that taken care of. Now as we talked about with that 504 loan, 40% of our total project cost is going to come from a second loan on the project. And we will, where you might ask, where do we get this additional 40% of our income from, or 40% of our total project cost from? Well, thanks for asking that question. The 40% can come from a number of different sources. Some banks in a number of communities, Tifton being one, do have a program developed so that they can do these gap financing tools in conjunction with another bank in town. But from a state perspective, we have two different sources. The Georgia Department of Community Affairs has the Downtown Development Revolving Loan Fund. It's, as the name says, meant to go to projects that are located in downtowns. It's a gap financing tool based on a 504 structure. And the Georgia Cities Foundation also has their own revolving loan fund that has very similar terms to what this DCA's revolving loan fund looks like. And they will also come in as a partner on these projects and put in 40% of the total project cost. So let's look and see what that looks like on the sources of funds sheet here. So 40% of the total project cost is going to be $126,000. So that's what that second loan is going to come in at. Their terms are 15% or 15 years, excuse me, at a 2% rate. So not speaking for any private programs that may be out there, but for both the DCA, Downtown Development Revolving Loan Fund, and the Georgia Cities Foundation Loan Fund, if your project is located within a Main Street community, those terms, those interest rates on those terms can be as low as 2%. If you're not in a Main Street community, but the project is located in the downtown, the term may be 3%. So a little plug for why Main Street is important and helpful with these projects, but also really this secondary rate here really helps make a lot of projects work, because you do have less interest you'll be repaying at the same time you're repaying the principal of the loan. So if we go back to our loan constant table, we see that our new constant for the second loan, go to the 15-year term, 2% interest rate. That loan constant is going to be 0.0770. Now, if you're looking on the PDF version of that loan constant table, you'll see that I don't have the 2% rate visible because that's not a common term unless you're using this gap financing. So you may want to look at the spreadsheet version, and I've got all those lines hidden on that document. You can unhide those. If you need a password for that document, the password is conveniently password. But that $126,000 loan with those terms and a constant of 0.0770 gives an annual debt service for the second loan of $9,700, giving us a total annual debt service, because we do have to repay both of the loans, of $27,700. This brings our potential owner equity down to some magic number of $31,500, which is conveniently exactly what our developer wanted to invest in the project. I love it when the numbers work out like that. So if you're following along on the spreadsheet, let's take a second and enter our new loan information on that loan principal payment page. So loan 1 will keep as our traditional bank financing, and that's going to be $157,500 for the loan amount. Our interest rate is staying at 8%, and our annual debt service is going to be $18,000. Now, you'll notice that at the end of year 10, there's still a substantial portion of that loan left to be repaid. And that's because, again, this calculator only goes out to 10 years, so we're not going to see all of it being paid off in 10 years. Those payments will need to continue at least until year 15 when the loan is repaid. The same goes for loan 2, which is going to be our second 40% loan, the loan that's covering 40% of the total project cost. That loan amount will need to be $126,000, so enter it into the loan amount cell for loan 2, and the interest rate will be 2% with an annual debt service of $9,700, giving us a total annual debt service again of $27,700. So let's take a moment and check out what the deal looks like compared to what was initially thrown on the table, which is traditional bank financing of 80% with owner equity of $63,000 or 20%. After utilizing the gap financing tools that we have available, let's see if the deal is better. We have lowered our traditional bank financing down almost $100,000, so that 50% of the project shows them putting in $157,000. The gap financing, the DDRLF that we're going to use from DCA, is going to throw in $126,000, and we're only going to be on the hook for $31,500, which is great. Another sort of truism in economic development is a response to the question of what is the best way to pay for a project? And it's your traditional OPM, other people's money. So the more money we can get from other people or other groups into a project, the better we are. And if we can reduce each individual component's liability in the project, then we make everybody happy. So why is the project better? It's because the numbers don't lie. With the traditional financing of the project, we had an annual net operating income of $36,000, which will not change. We had that debt service for our bank loan of $37,000, meaning we were losing every year $1,000. We had a low debt coverage ratio, so low that we weren't even able to pay back our loan. We've got to dip into our 401k or our child college savings fund, which is never a good position to be in as a developer. In our cash flow, our cash on cash rate of return, there is negative 2%. When we look at the gap financing option, we see that our net operating income again hasn't changed. Our debt service though clearly has changed. We're getting less debt for more people at better rates. So our annual debt service combined is $27,700, meaning we have a cash flow of $8,300. We also get to lower our owner equity, and we have a very high debt coverage ratio for both of our loans. Included in that, we are covering our debt by a ratio of 1.3, meaning that we have a 26% rate of return on the project, which is darn good. And so, looking at a developer who wants to invest $31,500 into a project, wants to make money, wants to pay back their bank loans, this is a project that's ready to go. But these tools are already available to most communities across the state, and a lot of them aren't taking advantage of it. Why is that? Because there's a chance to sweeten the pot even more. So I want to take you back for a second. I want you to remember my friend, Dr. Leslie. Dr. Leslie is a cardiologist. She's making $400,000 per year, and along with that higher income comes a higher state income tax of $24,000 per year that she's got to pay to the state of Georgia in state income taxes. So why might she be motivated to invest into this project? The answer, if you've already looked ahead, is clearly Georgia's Rural Zone Program. So let's take a minute and we'll talk through the Rural Zone Program and the tax incentives that are included in that, and then we'll apply these incentives to the project that we just looked at. So Georgia's Rural Zone Program offers 3 different tax credit projects to make a project happen. The first is the investment tax credit, and that will be a tax credit to cover 25% of the purchase price of the building and the property up to a $125,000 tax credit. The second credit associated with the Rural Zone Program is a rehabilitation tax credit, and this is for 30% of the qualified rehabilitation costs up to a $150,000 tax credit. Meaning, for our project that only costs $315,000, we are going to be able to cover all of those expenses with one of those 2 tax credits. And we'll go through those numbers in just a second. The third tax credit is because with the Rural Zone Program, there is a requirement to create jobs. You also can get a tax credit for the jobs that you create. We're not going to calculate for the purposes of this project what that looks like, because that's a little more fluid and sometimes may need to go to a business owner and not the developer themselves. We're going to focus on those first 2 tax credits that goes traditionally to the building owner or the developer managing the project. So let's look and see what the investment tax credit may be generated for this project. Again, 25% of our purchase price, and it's distributed over 5 years. So recall that our purchase price for the land and the building was $150,000. 25% of that $150,000 is $37,500. So this is the total tax credit that purchasing this property is going to generate for us. We'll spread that over 5 years. We see that Dr. Leslie, if she chose to invest in this project, would be bringing in $7,500 a year just in this investment tax credit that will reduce the amount of state income tax that she owes to the state of Georgia. The rehabilitation tax credit, again, is 30% of the purchase price, and it's distributed over 3 years. So recall that our rehab was going to cost $150,000, and we're going to go ahead and assume that we'll spend all of that contingency, because you always spend all of the contingency. And at least for the purposes of the tax credit, it makes the tax credit a little bit larger as well. So 30% of that $165,000 that we're going to be spending with the estimated rehab costs and the contingency will generate us a tax credit of $49,500. Again, spreading that over 3 years, we see that in the first 3 years, Dr. Leslie, if she chooses to invest, will see $16,500 wiped off of her state of Georgia tax credit, income tax bill, just from this Rural Zone project. And so, if we're following along on our worksheet, what do we need to do? We need to go back to that initial sheet that we looked at entering information. We need to go to the total project cost worksheet. We're not changing any of the costs associated with the building, so our land acquisition and our building acquisition stay at the amounts they were originally. Our rehabilitation and our contingency costs also stay there. We are going up to columns F and G at the top there, the rural zone investment state tax credit and the rural zone rehabilitation state tax credit, and we're clicking yes. This is going to tell the calculator to go ahead and run the calculations for those credits, assuming that you're taking all that you're eligible for there. We see that our total tax credit for this project, just with the investment in the rehab credits, is going to be $24,000 a year in the first 3 years, totally wiping off Dr. Leslie's state income tax liability. That's going to be reduced to $7,500 after the rehab tax credits run out. But in all, Dr. Leslie is going to earn $87,000 in tax credits just from doing this project. And so what does that look like from a post-tax cash flow standpoint? The calculator again builds that in, and we haven't gone through all of this in the presentation, but these are some of the more advanced features of this worksheet that you're welcome to work through on your own. You can see that this spreadsheet pulls in a lot of the information from the previous calculations. This is that post-tax cash flow sheet down at the bottom there. And the place I want to direct you to, we'll look at year one. You see we pull in our cash flow there at $8,200, our loan principal payments that we're going to be making. This will also calculate your depreciation cost if you want to incorporate that into your considerations. You don't have to for the purposes of today's example though. We do want to know what our tax liability is though. Dr. Leslie at $400,000 a year, filing federal income tax will be a 35% tax rate, but the state tax rate caps out at 6%. At the bottom, without the tax credits, you'll see that Dr. Leslie is only seeing, after she pays the taxes on the income she's earning from this project, is only really seeing about $2,700 extra in her pocket at the end of the year. After we click on the rural zone tax credits and allow it to calculate, however, we see that that number changes substantially. The tax liability, the state income tax liability that she is realizing in the first year goes down to zero, and that $2,770 of post-tax cash flow turns into $26,770. So again, asking about Dr. Leslie, that tax income, state income tax liability that she has of $24,000, will this incentivize her to take some extra capital she's sitting on as a high income individual in the community of Sylvester and turn it into a project? I think it might. This is in addition to just the cash flow that the project's going to generate. This is what makes the Rural Zone program really a beneficial program to pursue for your community. These tax credits, and this is not a presentation about all the intricacies of the Rural Zone program, but more just a selling tool to show how this program can help potential developers in your community understand the benefits of creating a project for themselves and their own tax liability. But would this incentivize her to take her income from the being a cardiologist in a larger community of Albany and invest it into her smaller town of Sylvester? I certainly think so. And again, one thing that I did want to point out that we didn't include in our calculations here is the job tax credit component. If Dr. Leslie opens her own business in that space, she'll be losing out on all the lease income, which is the major reason she would want to do the project. But whoever opens a business in that space would see $2,000 per full-time equivalent job for the first 5 years. So assuming that 2 jobs are created, that's going to be $4,000 a year for the business themselves. which helps offset a component, a portion of their rent component for that commercial space at the bottom floor. So let's walk back through today's session goals and see if we met them. We have talked through the common terminology, that alphabet soup that we looked at the beginning. We've used that to set up a potential deal that we've created here. We've talked through gap financing and understood, we now understand how we can use that to bring a project that where the net operating income may not support a large debt service. We've inserted some gap financing to bring down the amount of debt service that we pay annually, and also bring down the amount of owner equity that we have to put into the project on the front end. And we've also briefly touched on what the rules on tax credits may do to this potential project that we've set up. So I think that we've met today's session goals. Feel free to leave reviews or comments if you have other thoughts about today's session. Now we're pretty much done with the presentation, but I do, before I leave you, want to point you to resources if you have additional questions. This presentation will not be put up live. It will be put up as a recording due to some of the video components included with the presentation. But if you have questions about the Georgia Main Street program and the work that we do at a state level and what you may do in your community, feel free to reach out to Jessica Reynolds. She's the director for Georgia Main Street. You can reach her at the email address mainstreet@dca.ga.gov. And we have a website, www.georgiamainstreet.org. On that website, you'll find a lot of different training and resources that we've already put out over the past few years that you're welcome to look at and take advantage of. Those are all free, regardless of your status of Main Street community or not. And then if you have questions about Georgia's Rural Zone program, I encourage you to reach out to Cherie Bennett. She is the program manager for that program. There's her email address, and www.dca.ga.gov includes a page down the way for the Rural Zone program where you can find out more about the rules and regulations associated with that. So with that, I thank you for your time. I hope that today's session has been helpful. Whether you're an existing Rural Zone community who's looking at this to fulfill your annual training requirements, or you're a community who's considering the Rural Zone program, or you're just a community who wants to see a building in downtown be put back onto the tax rolls in a productive use and help build a sense of community for your town. I hope that today's session will help you work through that process. Thank you very much for your time, and have a great day.